to have you all here with us. We have an exciting panel of experienced lenders today to talk to you about how the coronavirus is impacting the financing and banking industry. So it should be quite the insightful discussion. Before we begin, I'm just going to go through a few housekeeping things. So as we move to the next slide, for those of you who are new to Opus Connect, we are a lower middle and middle market M&A focused organization. We are membership based with chapters in LA, Chicago, and New York. We do monthly events in each of those chapters. Currently, we're doing them virtually. And we also do deal sourcing events all around the country, I think 15, 16 different markets. So if you're interested in learning a bit more about Opus Connect, please reach out to my colleague, Jacob Zeffrin. He'll be more than happy to answer any questions that you have. As we move to the next slide, I want everybody to be aware of the Q&A option at the bottom of your screen. Our panelists will take live questions actually during the discussion. So please feel free to enter your questions there and our moderators will field those as they see fit. I'm going to move on to our sponsors, and we have over 120 people in here. So raise your hand as I come to your company, but these events would not be possible without the support of our sponsors. So I definitely want to give each of them an opportunity to say a few words and introduce themselves. I'm going to start with Jim Davidson at Avant Advisory. And Jim, I'm going to go ahead and unmute you right now. Please go ahead and introduce yourself and your firm. Jim, are you there?
Yes. Am I unmuted now?
You're great. Yeah, go ahead.
Okay. Thank you, Lena. Well, thank you. Avant Advisory Group is an operationally focused financial advisory firm. We've been doing a lot of M&A, about 30 transactions a year in one way or the other, and had 5 pending right before this hit. And all 5 of those blew up. Maybe 1 or 2 might come back, but that's, who knows, if at all. Suddenly we were doing some other things on performance improvement, and now those are distressed. And not only are we doing financial restructure, but operational turnarounds as well. So we've got about 3 or 4, and over the last 3 weeks, we've done a few helping companies do some of the take advantage of some of the new SBA program financing, putting package together and helping them with that. And that's pretty much what we do. Financially oriented, operationally oriented firm, now doing a lot more distressed acquisitions than we've done in a while. It's Jim Davidson of Avant Advisory Group. Thank you.
Thank you so much, Jim. Happy to have you with us today. Is anyone from GemCap in the audience? I don't believe so. David and Richard Ellis, longtime supporters of Opus Connect. They do asset-based lending. Their contact information is on the screen, so feel free to reach out to them if they can assist you in any way. Let's move on to the next slide. USI Insurance. I believe Josh Goldberg is in here. Josh, I'm going to unmute you for a second and allow you to say a few words, please. Josh, are you there?
Yeah. Uh-oh.
Great.
Can you hear me?
Yeah, we can hear you.
Oh, perfect. Okay. Hi, everyone. I'm Josh Goldberg with USI. We're the largest privately held insurance brokerage in the world. I work on a lot of M&A related activities within the insurance space. So I do a lot of due diligence on behalf of buyers. I'm currently working on a larger or a Japanese conglomerate that's trying to buy a manufacturer here in the States. Also do a good amount of construction and real estate. And I'm finding that even with COVID, construction has largely not been pushed back too much. And it largely depends on where in the country the product is going to be. I've also found that within M&A that has taken a decent hit, but for some of these projects that were kind of started before this whole thing began, that those projects are largely still on track to move forward, maybe just being pushed back a little. So thank you for the opportunity to participate, and looking forward to future calls and meetings, especially once this is over.
Thank you so much, Josh. We're going to move on to the next slide. And before we introduce Lawrence Financial, they are our moderators today, also longtime supporters and sponsors of Opus Connect. We're going to move on to Sapient Investigations. So David Kogan, I'm going to unmute you for a second. Please share a bit about yourself and your firm.
Thanks, Lena. Good morning. This is David Kogan from Sapient Investigations. We are a corporate intelligence firm working both domestically and internationally. We pretty much specialize in executive background checks, and we do a lot of M&A work, looking at management teams, joint venture partners, board members. And yeah, things have kind of been put on pause and on a lot of deals, it seems like. We also, we've always considered ourselves a little bit recession proof because we tend to shift to litigation and fraud in the bad times. So that's picked up a little bit. Anyway, it's always great to be with Opus Connect, and look forward to talking to you all, seeing you all in person in the future.
Thank you, David. So real quick, before we get to the discussion, we're going to move on to the next slide. We have a couple poll questions for you guys, for the audience to participate. So please take a couple seconds. We're going to launch the first question, and we just want to get a sense of how you heard about today's event. So we'll give you about 15, 20 seconds or so for everybody to mark their answers. We'll look at the results, and then we'll move to the next. Okay, so it looks like majority of people have voted. Most of you heard about it from Opus Connect, our sponsors, our speakers, so a good mix here. We appreciate you all again joining us today, and that's helpful for us to know as well. We're going to move on to one more question, and then we'll get to why you're all here. So if we can launch that next question. We want to know what best describes you. Independent sponsor, investment banker, are you on the equity or debt side, as a capital provider, service provider, or other? So we'll give everyone another 20 seconds or so to participate, and then we'll see who we have here today. Okay, great. Cool. So a good mix. A lot of people on the debt side, which is great, obviously given the topic of discussion. And again, this is helpful for us to see internally, as well as our speakers today, to know who they're speaking to. So wonderful. We'll move on now to the stars of the show. Without further ado, I'd like to introduce Larry and HAZE from Lawrence Financial. They are, again, longtime sponsors of our LA private equity chapter and are going to be moderating today. So I'm going to kick it over to Larry HORTWITZ. We'll navigate to that slide. And Larry, if you could go ahead and take it over, I'll leave it to you, sir.
Sure. So Lawrence Financial is our company. I work with HAZE. We started 30 years ago. HAZE has been a partner, a managing partner for 11 years. What our primary focus is on helping companies find capital, usually debt capital. We work with all the asset-based lenders, the banks, private individual lenders. We have myriad sources for capital, and we're happy to work with anybody we can find. We've been able to close a few deals even with the virus, and we can go into some detail about that later, but we're still very active. We're getting a lot of calls, and we're hopeful that we can close some of the deals.
Great. So HAZE, do you want to go ahead and introduce yourself? Larry and HAZE are co-moderating today. But, you know, Opus Connect, we'll step out of the way now and kind of let you guys lead the discussion, introduce our panelists, and we'll go from there.
Okay, great. Thanks, Lena. I'll just add that this panel is going to really give us a lot of insight to kind of what the debt market's doing right now. So Larry's going to handle the questions, but if you guys have any questions that you want to answer during the conversation, just do the Q&A and I'll go ahead and ping Larry on those. Okay, Larry, over to you.
Okay, so we have a very distinguished panel this morning. And what I'd like to do is tell each person, and then you can introduce yourself and tell the audience what you're doing and what you're looking for. So we'll start with Terry Keating, who is the CEO at Accord Financial. Terry?
There we go. Thanks, Larry and HAZE and Opus. It's a real pleasure to be here. It's great to be with the California chapter, and I didn't have to get on an airplane to do it. So I guess that's one of my silver linings. I stole your question later. Accord Financial, we are an asset-based lender, transactions up to $20 million. We've done a lot of work with independent sponsors, making acquisitions over the years, as many people know. And we do a great deal of work refinancing banks out of distressed situations. We finance receivables, inventory, and equipment. And we are a Canadian public company. I run our US business. We've been around for 40 years and look forward to another 40 years as we get through this difficult time. Thank you.
Okay, thank you very much. Our next speaker is Brett Horowitz from Tab Bank. He's the managing director and head of originations for the Western region. Brett?
Oh, we're having trouble hearing you, Brett. It doesn't look like you're muted, but technical difficulties. We're still unable to hear you. Why don't we move to the next panelist while we work that out, and then we'll come back to you, Brett.
Okay. All right, so our next speaker is Jonathan Schuster, who is the Senior VP and Vice President of Business Development at MidFirst Business Credit.
Thanks, Larry. So yeah, Jonathan Schuster. I'm with MidFirst Business Credit. We're a division of MidFirst Bank, which is a $21 billion privately held bank in Oklahoma City, Oklahoma. I'm based here out of Los Angeles. We have a national footprint, and I specialize in asset-based loans from $3 to $30 million. We also will do term pieces and stretch pieces for borrowers. So we are a bank-owned ABL. So a little bit more conservative than the non-bank lenders, but we're definitely perhaps more aggressive on price. And I cover the West Coast. And thanks again, Larry.
Okay, great. And then we have Oren Beldern, who is the Senior VP at Celtic Capital.
Thanks, Larry and HAZE and Opus Connect. Yeah, Oren Beldern, Celtic Capital Corporation. I've been a business development officer for the past 11 years at Celtic. Celtic's been around about 40 years now, lending to lower middle market companies to companies that, for whatever reason, can't get bank financing. So we finance receivables, inventory, machinery, equipment. We also do equipment standalone also now. So we do in all 50 states, and we have no financial covenants, no lockbox. And what I really like about Celtic, working at Celtic, it's been the same management team for the last 25 years. And the CEO, Mark Hafner, has signed a one-man sign authority. So great company. I think our customers love us. So Oren Beldern, Celtic Capital.
Good, good. And then we have Jeffrey Schwartz, who is the managing partner at Corbell Capital. Jeffrey?
Thanks, Larry. This is Jeff Schwartz, the founder and managing partner of Corbell Capital. I founded the firm in 2013. We are currently investing our second fund, which is a $350 million SBIC fund. The firm was really founded to bring a private equity approach to direct lending in the lower middle market, primarily cash flow loans and a unitranche solution from the top of the capital structure down into a minority equity position.
Okay, good. And then I think Brett has rejoined. Brett, can you hear me now?
We can hear you, but we can't hear him. Brett, you might want to try dialing in from your phone. Unfortunately, it looks like we're having technical difficulties. But
Okay, well, in the meantime, maybe we can get started with the panel questions, Lena. And
yeah, absolutely. And Brett, just chime in when we get your audio together.
so the first question that we have is, what is the availability right now of funding from banks and non-banks, and what is your outlook? And Jeff Schwartz, you want to take that?
Sure, Larry. We are only about 25 or 30% invested in our current fund. We have spent the last month or so on defense, working to stabilize our existing companies, provide access to additional liquidity, either through our existing revolver relationships or through the SBA's PPP program loans. We've also provided some additional capital and runway to our companies. But we are very much in business now, turning to offense and looking to deploy capital opportunistically in situations where good credits require capital to either deleverage or provide additional liquidity to their balance sheets.
Okay, good. Brett, I'm seeing you on the screen. Do you want to try one more time?
Yeah, how about now?
Got it. So tell us about
right.
what's happening at Tab Bank.
Sorry, guys. I apologize for the technical difficulties. Thank you for having me. So my name is Brett HORTWITZ. I'm with Tab Bank. I've been with Tab for about going on 11 and a half years. Tab is a bank that is focused on asset-based lending. So we look much more like a commercial finance back office than we do a traditional commercial bank. Because we have the ability to monitor collateral as needed, depending on what the situation calls for. So we have a variety of different ABL products, all the way from factoring to ABL revolvers, ledger lines of credit. And so we have a tool to really meet the needs of a company at any stage of their credit life cycle. So it makes us really flexible, really being able to address companies' needs today, particularly in the challenging environment, but migrating them more back to a more traditional structure as the market gets back to normalcy. So really excited to be operating in this environment, even though it's challenging. We believe that we are still doing deals and still looking to very much grow our portfolio.
Okay, very good. Terry Keating, can you comment on the medium and longer term impact on credit and pricing and deal structure?
Sure, Larry, I'd be happy to. I guess to a certain extent, it's hard to tell what the long term is, but certainly what we're seeing in the short run is tighter spreads on pricing, a little bit tighter, more conservative structures. Obviously, uncertainty does that, changes pricing, changes structures a little bit. And I think going along with that is we will see some fallout from in the competitive environment of some of the folks who may have been a little bit more marginal in the past. And so there'll be a little bit less on the supply side to compete with. So that's what I would anticipate we'll see.
Sure. Do any of the other panelists want to comment on that?
Yeah,
I think, oh, sorry, go ahead.
Oh, I was just going to suggest that risk has certainly been repriced in this market, and the availability of debt capital, I think, will be more limited, and the credit underwriting will be more selective.
Brett, did you want to add to that?
Yeah, I think I was going to say a similar thing in terms of pricing for risk, but I think particularly lenders are going to, when it comes to lending on inventory, when it comes to lending on machinery and equipment, which typically requires that a company has the ability to service their debt, as opposed to AR, which is a very much of a self-liquidating asset. I think on the equipment and the inventory side of things, lenders are going to look for more collateral coverage in order to try to secure themselves, as it still remains to be seen as to how the valuations in appraisals and things fall out from the current environment. So I think if you have the ability to be a little bit more conservative in terms of advance rates, or maybe maintain the same advance rates but have an over collateralization in a particular asset class, I think that's going to be where lenders focus.
Oren Belden, you guys do a lot of equipment in lending. Do you have any foresight on what's happening with that?
Well, we just had our marketing meeting this morning, and I would have to say that all of the number of packages we've received have gone down. The amount of proposal letters have actually gone up in April. I mean, we're looking at essential businesses, and we're also looking at the essential businesses customer base to make sure that they have the ability to pay our loans back. So, you know, in the past, I would say regarding the equipment loans, the area that we had where equipment values have really gone down before coronavirus has been the aerospace industry, where a lot of the appraisals that came back were a lot less what's going on with aerospace, with Boeing and whatnot. So as of right now, it's business as usual, just that we just got do a little bit more due diligence on our collateral.
Okay, okay. All right, well, moving along, Jonathan Schuster, what industries do you guys feel like are going, like oil and gas? Obviously, you're an Oklahoma-based bank, so are you guys hurting in that area, or you guys have it contained pretty well?
Well, mostly in the ABL group, we're not too exposed to the oil and gas and energy sector. Unfortunately for the oil and gas, they're getting hit from both sides. They have the corona on one hand and the dropping oil prices on the other. So, you know, it's not something that really is affecting my portfolio. Perhaps in the bank, more on the cash flow side, they're going to see some impact. But really on our side, we're also, as Brett said, we're focusing on that collateral, really leaning on that. But at the same time, we anticipate AR turned slow, inventory turned slow. So we're looking at the credit health of the company, how they're positioned, what the equity looks like in the company, management, the ability to raise additional capital if necessary to get through this. As Jeff mentioned, a lot of my clients are taking advantage of the PPP loans and the various SBA products, looking to defer rent if possible to help with cash flow as well. So I would say on the essential business side, it's being felt all around. Distribution, we have some commodities companies that are still doing well, but their overall collateral position is definitely been hit. With AR turning slower, inventory turning slower, but now and also their operations. You know, they have most of our clients, or all of our clients, are having people work virtually from their homes and off-site, and it's become disruptive. So everybody is just kind of feeling their way through this thing and trying to figure out where the light at the end of the tunnel is. But for the most part, I see the businesses really reacting well.
Very good. Hayes, did you have a question?
Yeah, so we've got some questions from our audience. One question, since we were on the equipment loan side, they're asking how to perform collateral inspections in this environment.
Okay, do you want to direct that to Oren?
Yeah, Hayes, I didn't hear you at all on that one.
They're asking, how are you performing collateral inspections to this environment?
Well, at this point in time, we have not, since the lockdown, at least in Los Angeles, we have not done an equipment appraisal yet. And historically, what we've done on deals where the appraiser could not see or do a site inspection, he would ask for the pictures and the lights and the plates on each piece of equipment. But we have not gone that route yet. As far as I know, it could be a drone down the road.
Got it. And then Terry, for inventory collateral valuations, what are you guys doing?
So, similar to Oren, it's kind of pretty early to determine. The last 30 days, it hasn't been necessary, but it is going to be a combination of, at some point, someone does have to go see and count it. Most of the inventory loans we've made, the inventory is in a 3PL. And so there's actually in place, managed by a third party, pretty good inventory counting and controls. And so we've been able to rely on that at this point. I think if we, have a lockdown that is severe and extends out another, 60, 90 days, then it's going to become a much more meaningful issue. The appraisal firms, the field exam firms are all working pretty hard to figure out how to do some more of this virtually. And we've been in regular dialogue with them.
Okay, great. All right, Larry, I'll let you go back and then we'll ask a few more questions in a minute.
Sure. So one of the industries that we've noted has been really hit hard is the retail industry for obvious reasons. Do any of the panelists have exposure in that area, and how are you dealing with that? Brett, do you have exposure in the retail?
Larry, we don't have really a lot of direct exposure to retail. We do have a lot of exposure in the transportation space. And, what's interesting is at the beginning of the coronavirus, stay at home issues, we saw a big uptick in transportation due to panic buying and some of the other things that were going on. So, but then, last week we saw a major drop off in transportation in terms of volume, in terms of purchasing receivables and things of that nature. So, the interesting thing about retail is, a lot of our customers that are shipping into retail are still, for the most part, operating on some sort of a skeleton crew. So we haven't had a major impact yet. We don't finance any retailers per se. So what we have seen is receivables getting pushed out. Some retailers have been very public in their announcements that they're just not going to make any payments until, for some of them, July 15th for some of them. And so what we are having to do is we are having to extend out some eligibility, maybe relax some cross-aging rules, things of that nature in order to accommodate our ABL and factoring clients. But, as far as direct exposure to retail, we really don't have a lot. And the ones that we do, we have some fortunate customers that this has been a major windfall for their businesses in terms of they sell cleaning products or certain things that are just flying off of store shelves. And so they've obviously had a positive impact. But, I think the fallout is just starting and we'll see what happens from here.
Jeff Schwartz, where do you see the opportunity with industries that are doing well? Brett alluded to the cleaning products area. Are there any other industries that you think are going to do well? And do you have investments in those, or are you looking for investments?
So and we don't have any direct retailers, but one of our investments is in a direct-to-consumer online liquidation business, which should benefit very nicely from some of the challenges that the more traditional bricks and mortar retailers are experiencing. And there should be tremendous supply of liquidated product that our system will allow us to distribute efficiently direct to consumers once the market opens up a little bit. So it's an interesting challenge for us because even online consumption from a consumer apparel and footwear standpoint has been down over the last 30 days since people have not been leaving their homes. We believe that there's a significant opportunity for this company to buy inventory at even lower prices than they typically have and make considerably more margin when the markets open up again for them to sell product direct to consumer. So the liquidation category and the distressed purchase and sale category has done generally well in a challenged economic environment.
Terry, I know a lot of the companies have said that they're deferring payments, not only retailers, but people like Boeing, Costco. How are you dealing with clients that call you and say, look, we're not collecting from our customers? How are you dealing with that?
Sure. Surprisingly, and we've been through every one of our clients actually several times, we've really had a limited number of requests for deferral of payments or stretched out AR terms. We've been able to work with our clients where we have had those requests to accommodate it. In our portfolio directly, we haven't had any specific requests for payment deferrals. Part of that is because the PPP and other government programs are starting to kick in, and that's buying a bridge for another 30 to 60 days. We'll see what things look like after that bridge, but so far it hasn't been a big issue. I would comment back on the retail question. In the US, we don't have any retail exposure, but in Canada, our sister company has a considerable amount of retail exposure. And really the answer that they've encountered there is it's the government support programs that are going to keep some amount of cash going through those retailers, and they hope to get open again soon. The longer term of when people are going to really be comfortable going back out and doing extensive shopping in person versus online is a much more vexing question that they haven't figured out yet.
Okay, good. Jonathan Schuster, where do you see opportunities? I mean, you're pretty new to the market, and so hopefully you don't have a lot of trouble loans on the books already, but where do you see the opportunities? What kinds of industries are you particularly looking at?
Yeah, I think across the board it's less about industries and more about, conventional loans for various prospects or banks getting out of conventional loans into the ABL world. You're going to see a lot of existing clients tripped up various covenants. And in that sense, we're looking across the board, in all the sectors of manufacturing, service, and distribution. Obviously, Brett hit on a little bit with the retail sector. I think you're going to see a lot of inflow of opportunities in the retail sector. Again, those are more high risk, and in the energy sector as well. But I think it's just the general company that's just tripping covenants and having to more lean on a collateral lender to get them through this period.
Okay, good. So looking forward, guys and lady, where do you think we're going to go? You see the fighting between, I guess, Cuomo and Trump about when the economy can reopen. Where do you see it going? How long do you think it's going to last? None of us have a crystal ball, but obviously, I'm sure your institutions have given you guys some direction or some idea of what's going to happen. Oren, do you have any feeling for it?
Well, one thing I got from a politics standpoint, that's above my pay scale. And, who's got the authority to do this? Who's got the authority to do that? But I got the advantage that my son is going back to New York City to get his residency at Mount Sinai Hospital. So he's basically getting right into the thick of things. And he's on the ball regarding all the stuff that comes from all these Johns Hopkins universities, all this data analysis, whatnot. And, he listens to Dr. Fauci very closely. So I think we got a little ways to go from the health standpoint. From an economic standpoint, you know what, the longer this goes, the more of an impact it's going to have on a lot of companies out there, especially the lower middle market, the undercapitalized type companies. So, the sooner we get back to work, the better the economy is, but the same token, we got to keep, people safe.
Terry, do you have any feeling about it?
Yeah, sure, Larry. Thank you for asking. We have a number of governors, particularly in the Northeast and on the West Coast, who are talking about making plans for beginning to slowly reopen their economies and maybe on some sort of a rolling basis. I think that's a pretty good indication that in the next 30 to 60 days, we're going to start to see that. But it's likely to be a very long, slow process because underneath this, we have that health issue. Until there's widespread immunity through antibodies or a vaccine, we're not going to be able to go back to anything resembling pure normal. So on the one hand, I think that is a positive factor. What I worry about, though, is the fact that we still sit in an economy where 70% of our economy is driven by consumer spending. We now have unemployment rates that are in the 20% range. Goldman Sachs projected this morning that we're going to see a 35% drop in GDP. And what we don't know is what that looks like to our clients and our lender portfolios as we get out 90 to 120 days. So there's some very difficult times coming unless we see prolonged and increased government support of our economy.
So Larry, I'm just going to interject really quick. Terry, there's a question from our audience.
Yeah.
And then maybe other panelists can kick in with that. They're saying that even though it's kind of business as usual right now in the lending sector, are you guys feeling there might be a lag factor in the results in the future?
Well, and thanks, Hayes. That's exactly what the point I was alluding to is I think there is a lag factor. First off, there's been this kind of initial shock and triage, and everybody's kind of shut down and taken stock of where we are. It's really only been about 30 days, so we haven't seen the effect of decreased cash flows coming through our business in that meaningful way. And then what happens 90 days from now when we have only a 25% return to economic conditions, which is likely kind of where we are. And that's a real unknown territory. The retailers, some of them are struggling by and continuing to pay people for a short period of time, but that can't go on forever. And we do have these high unemployment rates. Plus, we're going to have structural changes in some of our industries. Air transportation, hospitality, they're unlikely to go back to anything resembling 2019, maybe for years. And that is going to have to work through the economy. It's going to have to work through, how our lending structures are figured out. And there's just a lot of unknowns. And I think it's a long, hard slog.
Jeff, you've got a pretty diverse portfolio. Do you want to add anything to that?
Yeah, I think that lenders are typically thought of as looking in the rearview mirror instead of the windshield, and that's normally viewed to be a more conservative view than equity investors. I think in this case, it's actually a more aggressive view. I can't tell you how many different direct lenders I've spoken to in the last few weeks who've said things like, well, we think our companies are doing okay. We should make our covenants for 331 and we should get our interest payments. So I think we're going to be okay. And I keep saying to them, if you've got 11 out of 12 months in your LTM that are unaffected, you probably are okay. But if you look forward 1 quarter or 2 quarters, half the year is at revenue of 0, you'll have a very different picture. So I think that lenders are looking at their traditional credit metrics and looking at their companies and feeling okay about themselves. And I think that they're deluded in not getting ahead of this situation because many, if not most, of these levered companies are going to face liquidity issues over the next several quarters. I think it's inevitable.
And Hayes, I'd like to add, it also depends a little bit on where you are in the lending spectrum. As an example, at Accord, the vast majority of what we do is working capital driven. So we have clients, I have one client in particular who's 100% dependent on mall-based revenue, right? But all we do is factor receivables. Their receivables are paying and we'll be out of our exposure before long. But until malls reopen, that company is literally at a 0. And so if you are a working capital lender, you can have a little bit more comfort. If you are a big term lender, if you're an equity lender where you've got that kind of long-tailed risk, all these things that we're talking about are, as Jeff alludes to, are really going to come home to roost 120, 180 days from now.
And just to add to that, Hayes, I think that's where the to Jeff's point, the traditional bank is typically going to lend based on historical cash flows as opposed to an asset-based lender who is really much more focused on the collateral. And so I think with the government programs that are now starting to trickle in. So we actually just opened up our application process to the PPP loans last week, and we started having funds hit our customers' accounts yesterday. And so for this initial next 30, 60 days, I think the traditional banks, the Wells Fargos of the world, are going to do whatever they can to work with their clients. But I don't think there's too much of a question that 60 days from now, 90 days from now, those companies are going to be well outside of their credit boxes. And so I think that's when we're going to really see the impact, and where the asset-based lenders, those who still have an appetite in that market can really look for a lot of opportunity, because we are, again, looking at the collateral as opposed to just purely the historical cash flows and managing loans on a covenant basis. Red light, green light. You hit the covenant, green, you can stay. You red light, you break the covenant, you got to go. Those banks are just not set up to manage those credits. So I think the asset-based lenders are really going to see a lot of opportunity come out of this. I think in the 30, 60-day time frame. At the end of the day, it's still going to be tough. Whether it's inventory or machinery and equipment or whatever it may be that is dependent on cash flow as its principal source of repayment, that's where the magic is going to be in terms of getting creative and putting a solution together.
Thanks, Brett. So I'll ask one more question from the audience, and we can get back to our outline, Larry. They're asking, has the SBA loans, do you think it's going to affect the demand for potential borrowers?
No. Well, yeah, I think the SBA loans are just little stopgaps. I mean, obviously, these are just to get these companies, these lower middle market companies through, this period. But there's going to be a huge appetite. This is only going to be temporary. I mean, obviously, we don't have the crystal balls. People say we don't know how long this is going to last. But there's still going to be a major demand for conventional, working capital lines of credit. Absolutely.
Yeah, we agree with you. Okay, Larry, we'll ask a few more questions in a minute.
Oren, you had alluded before to aircraft machinery and equipment. So what's going to happen when there's some auctions that take place where there are few bidders or no bidders for that kind of equipment? As you know, historically, what the appraisers do is they take the most recent auctions, and that's how they base their valuations. So if there are a lot of sales that don't take place or are very low, how are you going to be able to generate new loans on those assets?
Well, I can tell you in the last year or so, I probably looked at 4 or 5 equipment opportunities, equipment only opportunities regarding in the aerospace arena. And the company presented me an old appraisal, maybe 6 months, a year old, gave it to our appraisal group. And I would say each one of those fell at least 50% in less than a year. And the present lender was underwater. So it's very difficult to do an equipment deal that's surrounded by aerospace. So.
Yeah, well, there are a lot of equipment areas. Terry, you do equipment lending as well. What are you finding as the appraisal values, the liquidation values go down? How are you going to assess a valuation on a new loan?
Well, we're trying to figure out where they are going, and it's too early to have any data. In talking to a couple of appraisal firms, though, the nearest experience that we've had, if you go back to the kind of 2008 timeframe, smaller pieces of equipment, this is what our appraisal and liquidation friends tell us. Smaller pieces of equipment under $100,000 were selling at the trough at about 10% below their recently appraised prices. Bigger pieces of equipment were selling as much as 50% below recent appraised prices. So we've tried to incorporate that a little bit into our thinking. We are about to close a new transaction, and it's all equipment, and that's how we've seen the appraisal got remarked by the appraisal firm, kind of along that basis. again, so much depends on what happens 90 to 120 days from now. If we can start to reopen this economy, you'll see some equilibrium come in, and you'll see a floor come in under values. If not, then it's going to be it's going to be a real free for all.
Jonathan, I think you mentioned that you guys sometimes do term loans. Is that right, or just is it revolvers?
The term loan will go along with a revolver, usually based on a piece of equipment or something along those lines. But really the main is the AR and inventory revolver.
Well, inventory is in pretty much the same category as certain industries, correct?
Same category.
Like the aircraft business, if an aircraft company has an inventory of parts and the planes aren't flying, then what's that inventory worth?
True. And that's a good question. It's one of those things that, you lean on the inventory appraisal companies in trying to establish that. But what's that demand going to be in the next 30, 60, 90 days? Or if this lasts even longer, we really don't know when this is going to end. So what is that inventory going to be worth? Well, the anticipation, hopefully sooner rather than later, as an example, planes will be up in the air. So you try to look at inventory that's still liquid. I'm looking at a deal right now. They're in the metals business. There's always going to be right now, construction is still going on. There's going to be a demand for steel, rebar, where, whatever you have, obviously it's easily liquid. It can be liquidated if necessary. So you try to look for maybe a commodity type product that's not so highly specialized, that has many uses across a lot of different industries.
Yeah, I'm not sure of everybody's portfolio. Are any of the lenders on the panel lending to apparel companies on inventory? Anybody have exposure there? Brett, do you have any? I don't think you guys have much.
We don't have much. We actually just funded one last week, though, it's specialty apparel. Again, to my point that I made earlier, in that particular situation, it came down to over collateralization. So we have a relatively small inventory piece on that loan, but our total loan to value is probably sub 20%. And so, but there's a number of factors that went into that decision or that structuring of that loan. But as a general rule, no, we don't have a lot of exposure to apparel. The apparel guys are very good at that, but I mean, I would assume that they're struggling with it right now because it's a problem.
Jeff, I think you talked about your liquidation company. In terms of new opportunities, I think your structure is more term debt, right, than revolving?
That's correct, but we are in the process of putting an ABL in place. And I think to Brett's point, the key for that ABL provider is to have one, an over collateralized loan, and two, significant loan to value. But having that liquidity is important for us because we are seeing real opportunities to buy distressed inventory at values that we feel confident we'll be able to resell at significant increased margins over time.
So Jeff, really quick from the audience, we'll just take it from that. They're asking, do you see private equity taking a larger part in 6 to 9 months in regards to new capital investments for potentially troubled companies at lower valuations?
Yeah, I certainly do. Private equity is nothing if not resilient and creative. And what we've seen throughout cycles over time is different firms have the ability to morph their investment strategy to figure out how to deploy capital on an attractive risk-adjusted return basis in all kinds of markets. So as they get their own houses and their own portfolios in order, which I think is everyone's top priority, then they will start to look to go on offense and figure out where there are opportunities to buy market-leading companies that have been unavailable to them at traditionally reasonable multiples. And again, we can talk about what historical multiples mean relative to multiples going forward, but more modest multiples nonetheless, and create buying opportunities that have not existed for some time now, as we've had a pretty strong market for M&A in over the last many years.
Terry, we haven't talked much about rates. So obviously the cost of funds, and I think all of you, except maybe not Jonathan, but everybody else is dependent on money coming in, and you're paying very low rates. I know Tab, you're paying virtually nothing for your money. Midford is probably the same. What kind of rates have you adjusted your rates upwards, or are you taking into account the cost of funds? How are you doing it, Terry?
Yeah, thanks, sir. Most of our loans are floating rate in one fashion or another. So we haven't made any direct changes to that. When rates go down, our customers benefit. Kind of ironically, 2 months ago, one of my clients asked for a fixed rate, and we gave it to them, which was unusual for us. And then they emailed me last week and said, since your cost of funds are down, do you think you could give us a break on our rate? You can imagine what my answer was.
They want it both ways, right?
Yeah. But in response to kind of some of the changes in the credit markets, Jeff was alluding to this earlier, risk has to be priced a little bit more richly today, because there is more risk in the market. And so we've tried to make some adjustment as we're thinking about new things, but we haven't seen any. It hasn't been a major shift in our thinking. We look at our risk, we have a pricing model, and we put in risk adjusted pricing, and comes out, and that gives us some guidance on where we price.
Brett, how about you guys? Have you, like the deal you just funded, was that predatory pricing, or was it your typical pricing?
Was that directed at me, Larry?
Yes.
No, so that deal had been in underwriting for a little while before the coronavirus situation. So pricing was not impacted. Had I, to be perfectly honest with you, had I looked at that deal today, I think the pricing would have been higher, just based on the risk. So I don't believe in bait and switch and trying to jack up the price at the 11th hour if even though the market had changed. So in that particular case, no. I think for new deals, we are going to see rates go up because of the risk. I think, by the same token, the strong companies, the companies that their businesses have either benefited or just remain stable in this environment, I think that they will get the benefit of the decreased pricing. But I think, where there's risk, there has to be reward. And so I personally see that is something that is being looked at on new deals going forward. But at the end of the day, to your point, we do have a low cost of funds. We do have the ability to be competitive. And so really the market drives a lot of that in terms of where a deal should be priced. What I think is going to be interesting is to see. I don't think it's surprising to anyone that I think over the last 5 years you've seen a lot of covenant light deals and a lot of very flexible transactions being done by a lot of banks. And I think it'll be interesting to see how painful those decisions turn out to be over the coming months. And I think that's what's ultimately going to drive the ability of some institutions to go out and be aggressive, because I think that there's a number of portfolios that are going to have some issues to deal with in terms of what has been such an uber competitive environment over the last 5 years, and people competing and giving up on some structural things that I think that's what I'm interested to see the fallout from.
Okay, so I'll ask another question from the audience. throughout this crisis, exits available to lenders are limited as there are few buyers for collateral and refinancing may come at the cost of a steep discount. Are lenders preparing to accept significant over advances to help their buyers ride this out? So, Oren, do you want to take that?
Hayes, you broke up on me quite a bit there.
Okay, so basically what they're asking is that, as this crisis moves on, are lenders preparing to accept significant over advances to help their buyers ride it out?
Well, we talked about that this morning in our marketing meeting. I think right now we're not impacted at all, but as time goes on, we will be impacted. So I'm sure the cross-age rules will be, flexible, over 90, 120 days, be flexible, so I think we'll work with our customers. Granted, it helps when we have additional collateral to be pledged during this time. So I'm not involved in portfolio, but that's my understanding from our management team. We're very flexible with our customers.
Terry? Terry, you're on mute.
Muted.
Terry, you have to unmute.
Got it. Sorry about that. I think to a certain extent, we don't have any choice, or we're not going to have any choice. And we'll make decisions like we've made them in the past, which is, is the present value of our collateral, selling it now and not accommodating it better than accommodating it and thinking about selling your collateral or surviving with the company down the road. But in a lot of cases, companies aren't going to have the cash flow, and you're going to be forced into this over advanced situation, whether you like it or not. And so I think the answer is yes.
Okay. So I'll just add another question that kind of is along those lines. And then Brett, you can maybe answer that. It says, while there may be a delay in reduction of accrued based revenue, how carefully will lenders be watching the collectability of receivables as a leading indicator?
So I'll take that one. I mean, I think absolutely that is going to be a critical thing for asset-based lenders. I mean, asset-based lenders really, for the most part, look to the receivables as the primary asset that they're lending against, and build advances against inventory or machinery and equipment around that. And so I think collectability of receivables is a huge leading indicator. If this thing continues to go on for many, many more months, then, we've got a really big problem on our hands. I think for the most part, the viewpoint is that right now we believe that the receivables are still collectible. They may get delayed out beyond the level that we're comfortable with it during normal times, but I think that they are ultimately still collectible. So I think that is a major leading indicator that we're gonna watch. I think, tying into the previous question, we've been fortunate in that very few of our ABL and factoring customers have come to us for accommodations or over advances right now. I think the PPP loans and the disaster loans from the SBA, I think, are going to be a nice short-term Band-Aid to the problem. They're obviously, and it's just going to allow us to kind of kick the ball down the road a little bit, and then see how it all turns out before we have to make those over advances. I think every lender is going to have to be careful not to throw good money after bad if the situation appears that it's just not recoverable. There's going to be some tough decisions to make. I think all things being equal, our advance rates on collateral that would be liquidated, has a decent cushion in there. So I think, I think if we were to look at our portfolio today, I don't think that we would be that far underwater based on where our advance rates are. The longer that this thing goes on, who knows? It could be a pretty drastic thing, and we are going to have to make those tough decisions as to, do we continue to over advance and keep the doors open, or do we liquidate and take our chances on collateral values?
Got it. Okay. So, Jeff, I'll address this question to you because I know you have a lot more flexibility with your lien position. One of the audience members wants to know, how do lenders feel about subordinating to the government-backed loans, the EIDL, the PPPs, even the new announced mainstream loan program?
Well, I guess I'd say a couple things on that. The first is we've put PPP loans in place for most of our companies while they're unsecured, and we're secured, so they're structurally junior. Given the repayment schedule, if in fact they do need to be repaid, they do come in front of us. But I think most lenders feel like we shouldn't be saying no to liquidity that's coming in any form or fashion. So this is certainly attractively priced capital. And in most cases, if your borrowers handle their paperwork correctly, most of that loan should be forgivable. So I don't really view it as so much senior in terms of the, I think the liquidity benefit that you're getting far exceeds the risk of being layered by a piece of government capital that, who knows what's going to end up happening to it.
I think they're asking, like, in future deals that maybe you're looking at, if they have these loans and these liens exist, will you take a second position and finance them?
Right, but the PPP loans don't have.
Right, but the other loans are longer term.
But they're also unsecured, so they would be, in theory,
Yeah.
structurally subordinated to us.
Effectively.
Yeah. So, Hayes, I would say that for us, and it's interesting because I'm actually going through some legal document negotiations at the moment on new deals that we're in the middle of booking, and a lot of these issues have come up in the discussion. We are, and borrowers have asked to insert specific language as it relates to the PPP and the EIDL loans, et cetera. To Terry's point, the PPPs, we're encouraging everybody to take them. They are, for all intents and purposes, free money. The other programs, the Main Street loan and the EIDL, I think our position on that is, if there's going to be any sort of a lien position, or if there's a debt service, or if it's going to impact their debt service coverage, we're fine with those loans being in place so long as it doesn't put them out of covenant. So I think that those conversations are going to continue to evolve. But at least for now, for what I know about the PPP and the EIDL, I'm not 100% sure about the Main Street loan program. But they're unsecured, and so we want everyone to take advantage of them because it's good for everyone.
Right, thanks.
Good. So I wanted to talk about geography for a moment. And again, Jonathan, I hate to pick on you, but my guess is that Oklahoma is one of the hardest hit areas in the country. Do you have any outlook, as your bank, given any outlook in terms of geographic exposure?
I have to tell you, I'm mostly the ABL group is in Atlanta, and I cover the West Coast, so I'm not privy to a lot of what's going on in Oklahoma. But with that said, in our geographic area here in the West Coast, we are still looking at deals. And same in the Atlanta area. As everybody said, and I think as Brent alluded to, cautious. We don't know what's going to be, any geographic sector is going to be like in 30, 60, 90 days. But what we do know, obviously, in some of those Midwest and the Southern sectors, those are going to be hit hard, and those timetables for those areas to recover is going to be a lot longer than the coast. But as far as here, again, we were just waiting. I think everybody's in a wait and see mode. We can project out 30, 60 days, assuming that everything's going to return down to normal. If it's not, then we have another government infusion of capital for these small businesses. There could be another round of this, and we could be having the same conversation again. It's just so hard to tell. And from a geographic perspective, everybody's going to be hit hard by that time. So it's just so hard to tell right now.
Terry, you had mentioned, I think early on, about potential failures of finance companies that don't have heavy capital and that are exposed to, equipment inventory that, and even AR that's not collecting out. Do you foresee a lot of companies going out? Do you see opportunities for you guys to buy them? What's your outlook on in terms of the consolidation of the industry?
Well, I think it's always inevitable when there's a bit of a credit crisis. This has the potential to turn into a little bit of that we'll see some fallout, and so that is certainly an opportunity. We've turned a little bit of attention to what is it we would be interested in. A lot's going to depend on what kind of support these institutions are getting from their lenders and their capital providers. And again, a little bit early to determine. I was on a call yesterday with a very significant lender to the financial services industry. They themselves very strongly supporting their customers, but they noted 2 other lenders who are pulling back and have started to call some of their lines in. And so, what may not be completely a credit problem becomes a liquidity problem. And for a finance company, liquidity or a lack thereof can be death. So yeah, there'll be some opportunities, Larry, both for, companies and or parts of portfolios.
Yeah, I was prophesying that there'd be a great opportunity for a new, well-capitalized company to come into the market without any legacy failing items in their portfolio. So I think there's going to be opportunities. I think a lot of the private equity companies are going to jump into the market.
Yep.
You have no bad loans. They'll just come in and start afresh. And
well,
they can pick and choose what they want because there are a lot of deals out there that people don't want to do.
And Larry, to your point, I'm personally aware of 2 companies that are in the process of being formed and raising capital or have raised the capital right now.
Yeah. So I see that as an opportunity. We have just a couple of minutes left. HAZE, is there any other question that you want to raise from the audience?
Yeah, Oren, I can address this one to you because I know you do a lot in the equipment sector. I know this industry requires that. They're asking, are you seeing any interest among lenders in the hemp and CBD industries?
There's some lenders that do that. We don't do it, but I know there are some lenders that lend to that industry.
Okay, and then the next question that we have is, they're asking if it says, how backed up do you think the court system is going to become to enforcing your rights, and how will you mitigate that?
HAZE, I was on a call 2 days ago, or Friday, I should say, with a group of bankruptcy lawyers and turnaround guys. And this was one of the things that they were very mindful of in the short run, that, right now, many of the courts, they've sent all their people home. And so there's a little bit of a freeze there. And the few judges that the bankruptcy bar had spoken to made it abundantly clear that they were looking for lenders to solve things out of court and not in court. And that at least for some period of time, it is probably not going to be a lender-friendly environment.
Got it.
Yeah,
So Larry, maybe just do your finalized question to the panel because we have about 5 minutes.
Sure. So I wanted to go back for a moment to the rate question because I think Corbell, specifically Jeff, you guys have a lot of flexibility on rate. Are you adjusting your pricing for new deals?
So I guess we're approaching pricing in 2 ways, a little bit of a barbell structure. We've been priced out of what I would call higher quality credits over the last several years. The sponsored companies, the lower levered companies, the slightly larger companies. And we believe that now there's an opportunity for us to lend to those higher quality businesses and larger businesses and better finance businesses. So we're not increasing our expected cost of capital so much as improving the credit quality of the opportunities that we're looking at. The other end of the barbell would be the more challenged credit opportunities, whether it's because they're smaller, just inherently riskier businesses, or because they're facing greater challenges due to this corona crisis, or are not as well positioned to recover a weaker overall economic environment. Those are situations where we would be willing to take greater risk, but would expect more return in the form of equity generally, because these companies that are challenged are not necessarily well positioned to take on significant debt burdens. So we see opportunities to find businesses that we believe in the long term and get real equity stakes and true partnerships. If we stay with these management teams or with these sponsors through this more challenged period, we would expect to be rewarded coming out.
Right, right. Okay, well, the last question is more of a personal one. And from looking at the screens of everybody, it looks like most people are working from home. How are you, and some of you I know have younger children at home. How are you, how is everybody coping with that situation? Brett, I know you have two young active guys. How are they doing?
Thanks for asking, Larry. You know, it's not without its challenges. It's you know, I work remotely, you know, during normal times, so I think it's a little bit of less of a shock to the system as it is for a lot of other people. But you know, it's important to try to balance the things that are going on at home and the change to the routine and structure for the rest of the people living in my household, and trying to be there while also still trying to be productive and get things done. So you know, hopefully it doesn't last for too long a period of time, but I think everyone's just doing their best to adjust. And you know, as a bank, we are pretty much almost 100% working remotely, which has been interesting and actually pretty incredible to see that in this day and age, you can operate a bank remotely. I don't think a lot of people ever really would have thought of that being something that would be easily translatable. So I think, you know, fortunately, we are an internet-based bank to begin with, and so we've held up well in these times, and hopefully a lot of other banks who maybe had not been so technologically focused, I think that this has forced them to reevaluate that, and I think you know, it's something that can clearly be done. So that's my thought.
Not good news for office building developers, probably. But,
No, I don't think so. I think a lot of these changes, you know, the technology, the Zoom meetings, the things of that nature are going to now be a very much more real part of our life, even once we do return to normalcy.
Or the travel industry, Larry.
yeah, that's another one.
Yeah, absolutely.
No, that's going to be really, really difficult to recover. Jeff, how's your family holding up? Are you quarantined and you're doing?
Yeah, we're doing okay. I've never been particularly efficient working at home, so I've had to learn how to do that. And we're trying to keep the team together, doing regularly Zoom calls and trying to make sure everyone is productive and engaged, and also staying sane, because these are challenging times, and taking care of your team is more important in some ways than taking care of your portfolio.
Yeah, it's true. Jonathan, I know you have young kids too. How are you guys coping?
It's a good thing we have that mute button. You know, it's like everybody else, it's been a challenge. You know, it's you know, really new for them. I think, you know, part of the challenge with them is obviously they don't see their friends. We're their entertainment, we're their educators, and trying to balance, obviously, being productive on the work end. And so, you know, definitely a lot of get to know your kids, but, you know, it's one of those things that we all have to adapt. Everyone's adapting. I think everybody's very forgiving about the situation. I think, you know, the video resurfaced from that news reporter talking about North Korea and you know, when the kids walk in and the baby and the nanny, or the mother, excuse me. And, you know, I think those things happen, and everybody kind of expects those little things to happen. But it's a tough environment, as Jeff said, working from home every day. You have to learn to adjust, but there's been worse situations, and luckily for technology, Zoom meetings, all that stuff, we can still meet with people. Kids can still meet with their friends and get their school lessons online. So it could be worse.
Yeah. HAZE, are we out of time?
And let's talk to Oren and Terry really quick about the same question, and then we'll wrap it up.
Go ahead, Oren.
Well, you know what? I know Terry had talked about the silver lining. You know, I have 4 children, and all 4 have been home for the last 2 weeks. But in about 2 more weeks, I'll be down to 2. So it was kind of nice to have all my children back home for a short time, get to know them before they get back to the workplace again. So that's the silver lining in all this. So I'll miss them again, because I probably won't see them again for maybe 4 or 5 months. So for those 2, the other 2 are at home. So again, it's fun to have them around also.
Terry?
Yeah, so in our household, we don't have kids. And I remember about a month ago, my wife was very anxious that I stopped traveling. As many of you know, I travel kind of perpetually. And so she was very anxious and pleased when I came home. But I think now, you know, kind of 4 weeks on, it reminds me of a story I was once told. A guy who had retired early in his life, and his wife came to him and said, after about 6 weeks of him being home, honey, I married you for better or I married you for worse, but I didn't marry you for lunch. And so I'm not sure when my wife is going to force me to go back to the office. Now, in all seriousness, we're managing very well and getting through, and I'm enjoying spending additional time with my wife that I didn't have before. So it is a silver lining, as Oren was alluding to.
Good point. Okay, so thank you, everybody. I really appreciate your participation. I think at the peak, Lena, we had maybe 170 some odd people online. So
Yeah.
Good.
Yeah, thank you everybody for joining. Thank you to our panelists and our moderators. We really appreciate that. I think it was a very insightful discussion. I again, of course, want to thank our sponsors, Avant, GemCap, Sapient, USI, and of course, Lawrence Financial. We hope you enjoyed this event. We do have another webinar planned for this Thursday. It's on cybersecurity and making the shift to the remote workforce. So definitely look out for information on that and tune in. But we'll see you guys again soon, and we hope you all stay safe and stay well.
Thank you very much.
Thanks, Lena.
Thank you.
Thanks, everybody.
Thank you, everyone.
Stay safe, everybody.
Okay. All right.